Good afternoon, everyone in Europe, and good morning to our US listeners. It's now 3 o'clock exactly here in Geneva, and in true Swiss fashion, we will start the webinar. My name is Paul Newsome. I'm Head of Investment Solutions in Unigestion's private equity team. Welcome back to those who have joined our previous webinars, and welcome also to our new attendees. I hope everyone has been managing well during the varying degrees of lockdown and, dare I say it, opening up around the world. The topic of today's webinar is the small and mid-market, and specifically how we should expect companies to perform during the current crisis, drawing upon our experience of prior downturns, and also where we believe the best investment opportunities will emerge from in the short and medium term. Today, I have with me Federico Schifrin, partner on direct investments in the US, and Francesco Alderizio, partner on direct investments in Europe. Both of them have been doing private equity deals at the small end of the market for over 15 years. Now, I encourage everyone to submit questions as we go along. You can do that by entering them into the dialogue box on the side where it says questions. These will only be seen by me, not by the rest of the audience. I will then address as many questions as possible at the appropriate time during the webinar. But first, in order to set the scene before we talk about the markets, a quick refresher on our approach to direct investing. As many of you know, our direct program targets investments in global small and mid-market companies where we invest alongside investment partners, be they specialist private equity fund managers with whom we are invested, fundless sponsors, or other industry experts. We have a global team which sources over 400 deals per year and executes around 8 to 10, demonstrating our high selectivity. We've been making direct and co-investments since the late 90s, so depending how you count, we have navigated through 3 or 4 cycles over the last 20 years. But why do we like the small and mid-market so much? We believe that this is where we can find highly attractive, resilient companies where growth is driven by robust long-term investment themes. Now, it's exactly in times of crises that this point is proven out. So, for example, let's first consider how the small and mid-market has historically performed during prior crises. So using pre-Quinn data, you can see on the left side chart, we took a look at the performance of small, mid, large, and mega funds during those quarters which have shown negative GDP growth. Interestingly, small and mid shows the most resilient performance. Why is this so? We think it's because small and mid companies, specifically those backed by PE, typically have lower leverage, have more agility to make quick changes in costs or strategy, and tend to be playing in niche sectors which are less affected by GDP. The next question is, how do small and mid-market funds perform coming out of a crisis? Here, it is probably less surprising. Lo and behold, if I just get onto the next slide, the best vintages were those in 2008 and 2009, clearly when such funds were able to take advantage of lower prices and then the subsequent economic recovery. By the way, co-investment funds which typically have enhanced performance due to, amongst other reasons, a lower TER, did particularly well in those vintages, as shown by the dark blue bars. So, next we'll illustrate these points by talking about a couple of company examples from the last crisis, and then we will consider if these arguments will still hold true for the current crisis. So Federico, if you take us through the next example, please.
Thank you, Paul, and good morning, everyone here in the US, and good afternoon in Europe. We'll quickly talk about a business called Data Explorers. This is a business that is continues to be focused, or was focused in providing information to the global securities lending industry. This was a typical lower middle market company with all the characteristics that we like in the lower end of the market. A high need for the service provided, in this case it was data, high barriers to entry. This data actually produced or resulted in other data providers having a difficult time entering into this market. high levels of recurring revenue. And in this case, particularly what we liked was the fact that it was a no leverage type transaction. So it had no debt. This investment was made in 2007. In 2008 and 2009, we entered into the GFC. This business actually did really well through that crisis, and then emerged from that crisis actually stronger, as many competitors had effectively exited the market. As you can see, we derived a very strong return of 2.7 times our invested capital. And I think if I were to summarize or say what the corollary of Data Explorers is that in the lower middle market, we can find these really interesting companies that have a very unique set of characteristics that we can buy at interesting prices, that we can buy them without leverage, and that even through crises, you can find opportunities that will thrive either through the crisis or coming out of the crisis, such that an investment can be made in times of turmoil like the times that we're living in today. So going on to slide 6, I pass it over to Francesco.
Hello, everyone, also from my end, and welcome to the webinar. In this slide, I'd like to guide you through an example of an investment we did before the last crisis. It's an investment in a company called Premo. It's based in Spain. Small companies, about 40 million sales at the time we invested, focused on RFID transmitter, mostly for applications in the automotive and the solar fields. I think this is a very good example of what Paul showed before by mentioning the statistics, which are demonstrating how small companies are very resilient in time of crisis, especially as compared with larger companies. And here we can see that clearly when we invested in this company, we saw that there were very strong long-term trends on the back of RFID technology penetrating the reference markets of Premo, automotive and solar fields. We didn't expect, of course, the GFC, but when it hit, it was lucky for us to be in a small company, because on one hand, we didn't lose the opportunity, because the opportunity was still there, that the RFID components and technology of that sense was still penetrating very strongly in the reference market. We still had a few quarters to deal with of underperformance, and working with a small company gave us the chance to readjust the structure of the company, to reorganize to the new market conditions. As you can see on the slide, with the structured debt, we strengthened management, but most importantly, I think in 2 quarters, we restructured the international operations of the company, which was key for the company to stabilize again and to capture opportunities that were still in the market. So on the other hand, Premo was able, after that, to quickly refocus its strategy to continue growing and having the benefit, as a small company can, focusing on small niches, which are still growing even in an industry which is not doing so well, like the automotive. This still allowed us to make a return of 1.3 times our money, which clearly was below our initial expectations, but still a return, while many deals in the sector for pre-GFC vintages were write-offs or lost money. So I think here we can see how working with small companies can be advantageous in times of crisis. On the next slide, we are trying to capture and represent you what is our take on the current market condition. I would say clearly this is what we're going through, all of us. It's very different from the GFC. What we are witnessing, it's a global external shock, which never happened in the modern history of financial markets. I would say, notwithstanding, we have some experience now, still no one can tell the duration and the depth of this crisis, but clearly it will be very material and will trigger a global recession, which is also something we have not experienced in the last 10, 15 years. So the challenge here is that we expect very asymmetric effects across sectors. As we can see some examples on the slide, still trying to witnessing to you what we experience every day in the market. We have still seen transactions happening in the last quarters, in the last 2 months, but clearly it was very selective, and most of the transactions we have seen happening were in infrastructure like IT or B2B services, food products, and the food value chain. These are still very attractive markets where companies have not been affected too much, and there is transaction activity. Still, the current environment makes the underwriting fairly challenging. I believe valuations need to be based on fundamentals back again, and relative valuations like multiple long-term LTM EBITDA are less relative because the underlying markets are changing. What makes the current situation very interesting, on the other hand, is that structuring is possible again because the market has turned. It is a buyer's market out there again now after many years. So vendor loans are back, earnouts, very material reinvestments from the sellers, and hence on the back of that, the opportunity to structure the transactions for the new investors in the form of senior equity layers in order to strengthen the risk return profile are very much available and should be used. Clearly, select for resilience remains the trick, the secret. And I would say this goes in 2 dimensions. A very clear dimension in our experience is to judge management skills to succeed in challenging times. Very clear. I think it's very clear that there's a good percentage of management teams out there who have not witnessed a crisis for the last 12, 13 years, and so to test their skills to go through uncertain times, even in companies where there's still an underlying growing market, is very important because the environment will be challenging for everyone. So this is a key element. Clearly, higher visible revenues, differentiating client base, and avoid concentration of risks, and keep a low leverage are also very good factors. For us, a very important thing is to work with the right investment themes, meaning, as we can see on the next slide, meaning that we want to invest, and we believe that the best opportunities out there are many and are the ones to invest in companies which can benefit from multiple mega trends and can take the benefit of multiple positive investment themes. What you see on these slides is the way we come to our investment themes. On the left hand, you can see we select, in this example, we select 3 mega trends: evolving demographics, technology progress, and environmental challenge. And once we have identified those and backed by beliefs and research, we try to identify what are the investment themes, i.e. what are the type of companies or segments that we can then use to find companies or to back test our deal flow against, that are backed by interesting investment themes out of those mega trends. You see that evolving demographics and technology progress bring very interesting themes. The future of work, I think everyone can relate currently to what's going on in the world with COVID. The healthcare system and engineering, the converging security and safety, and service efficiency, especially remote services, software as a service, all these themes are backed by these investment themes. Now, without going too much in the details, I would say we are very proud of those because, as you can see, these are 9 investment themes. We are working with those very same. I think the ones of you who know us for long have seen these investment themes in presentations since the last 4 or 5 years. So you can witness that those were the ones. And we see 7 out of these 9 very strongly benefiting or being amplified by the COVID crisis. So this makes us believe that we are very much on the right track. And I think this is a very good map for investment selection and checking in the next quarters. On the next slide, you can see how we come at it more from a bottom-up point of view?
So bottoms-up point of view, or another way to say it is where the rubber hits the road, where we are, or the market is really actively looking for transactions. And what we see, I think, what the theme or trend that cuts across what we see on slide 9 is really that the most interesting opportunities are going to be the ones where incremental capital is supplied to solve a specific need or a specific problem. So when we talk about, for example, talking about cash for growth, what we're seeing is in this environment, as Francesco said, where it becomes more of a buyer's market, there may be significant opportunities to fund growth. There may be opportunities to fund consolidations, to fund add-ons. And what we believe is in times of let's put it, jittery supplies of capital or capital that is a little more risk averse, having capital to solve these opportunities allows firms to really access what I would call unique proprietary opportunities that can be that one can take advantage to construct a transaction that makes sense from a risk reward perspective. In that vein, what we see, so that is the view from the market. Now, what we see is that those opportunities are really happening in our expanded portfolio. So we follow about 4,000 companies through our own portfolio and also through our partner GPs portfolios. And it's in those companies that we are actually starting to see the green shoots of opportunities where there is a need for external capital to help or come to the rescue of a specific problem. And what we will see in the next slide is one example specifically of how this bucket of opportunity is being addressed by firms like ourselves. So
Federico, Federico, just to interject, I've just got a question that's come in. How would you compare the opportunities at the small end of the market that you've just shown to those that people might see at the large end of the market?
Thank you, Paul. Good questions. I'll try to frame it with some numbers, but and I'll talk about the U.S. In the U.S., there are about 100,000 or 150,000 small companies that are, I would call it, in the addressable, investable market. And on the other side, the supply of capital is actually surprisingly limited for these number of opportunities. And I think mostly because there's a certain level of inefficiency in the access to these hundreds and thousands of companies. So if you take those two numbers, a very large subset of companies and a smaller subset of capital, I think it becomes quite relevant to say that, or quite obvious to say that there is an inefficiency in the pricing of these transactions that I think are a lot more interesting or a lot more attractive to access from the small and middle market. So effectively, what we see is supply demand of capital imbalance. That's number one. We also see companies that have low hanging fruit, that there's a lot of operating things that can be done with these companies from a very early stage of ownership, companies that are hungry for growth or are hungry for consolidation opportunities. So if you take all of that into account, I think it makes it more attractive, with one big caveat in my view, which is selectivity is important. There is a broad dispersion or broader or higher dispersion of quality in the small and middle market. So what you need to have is always a framework, a lens to try to address the right company as opposed to any company in the small and middle market. But broadly speaking, I believe, or we believe, generally speaking, that it is a much more attractive market because of those inherent characteristics that the market has.
Thank you.
So going back to slide 10, we were talking, or I was mentioning that capital as a commodity that is coming to solve a specific need. Project Opera is a company that today lives in the portfolio of one of our GP partners. It's a company that we have known for about 15 years, which is about the same time we've been investing with this GP partner. And this company has a very specific need. It has the wrong shareholder base for the crisis that is coming, and it has the wrong shareholder base for the long term. So a group of shareholders, our GP partner, has asked us to come in and see if there is a way in which we can solve that inequity in a way, the discrepancy in objectives that shareholders can. So we are working to put together a fairly complex transaction that would allow us to both take out an existing shareholder at what we think is a very attractive price, provide some capital for growth for the business, and really create a transaction that by nature has significant downside protection. So to put it into context, what we're trying to do is create through the transaction an implicit return of at least 1.5 times our investment, and then create a structure via which not only do we have an implied downside protection, but we have significant upside capture in this company. We believe that the sector that it's a billing software company with a high recurring set of revenues, is a business that will be probably bought by one of the strategic players in this market. We think that the transaction that we're crafting, if we can get it closed, but that we're crafting, will allow us to capture significant upside if and when that happens. And we think that we're partnering with a great management team that's done a great job over the last 5 or 6 years in taking this company to where it is today. We're partnering with another GP, which we think quite highly of. We're creating a transaction which is actually unique and quite proprietary in nature. And we think we're exposing ourselves to a market that has a very, very high degree of long-termism in a way. It's a business, or it's a market that is going to exist beyond the crisis, and it's only going to grow because of its inherent characteristics of being a software that is core to a very specific set of companies, of global companies that it services today.
On the next slide, you can see another good example of the opportunities which are still there in the current market. This is a company called HEALTHTECH BIOACTIVES. It's a company which is the first investment of our new direct program, Unigestion Direct 2. And the investment was done in January, so pre-COVID crisis, or while the COVID crisis was unfolding in Asia. Still, we saw that the company, which is active in food supplements and vitamins for the food market, was a very interesting investment opportunity. We invest in the company basically due to, on a higher level, 2 very strong investment themes that, according to the charts I showed you before, which you can really see here at play. The 2 are, on one hand, the personal well-being and the healthy consumption. I think we can all witness how much we want to be and eat healthier, and give strong considerations to these aspects in our daily choices for products and services we buy. So this company is clearly benefiting from this, because basically, simply said, the company provides ingredients for fruit juices, for any other sort of industrial food and beverages, which allow those to increase their content of vitamins, of healthier substances, so that they can be as healthy and as good for the body as natural products, which is a very strong mega trend in the industry. Localization of supply is the other investment theme, which is backing HTBA and its growth. We all know that efficiency and environmental considerations are becoming stronger and as important as cost optimization for companies, and hence supply chains need to shorten. Now, HTBA is, from the diligence we've done, the only supplier which has no dependency from Asia for its supply. The full value chain is based in Europe, and hence can offer to the clients a very low environmental footprint, a very quick response, which is also very important, because as we know, the shortening of supply chains and more on-demand operation between clients and suppliers, it's a very strong mega trend in general, and it's particularly strong in the food industry, which is reducing constantly level of inventories and working more on demand, and hence again, the localization of supply, it's a must. And we strongly believe that companies that have localized, still efficient, but localized supply chain are the winners. This was now very much pushed and challenged by the COVID, because with the COVID crisis, I would say we have the proof of those two aspects being very true. On one hand, people even quicker and even stronger moved towards healthier food products. And also with the initial issue in China, having full control of the supply chain and being able to react to market very quickly was a key success factor. The company experienced in March plus 50% of orders intake compared to previous year and previous months. Why? This was because the clients wanted to order the products from who had it available for sure in the coming months. And again, having the full supply chain in Europe was a key success factor. In April, still, we experienced 25% order intake uptick, so a little bit less than March. Clearly, there was a stocking effect by the clients, but still we continue seeing, and even in the first days of May, we witnessed a very strong uptick. So we are very happy of the development of these companies, and I think it's a very good example of how still in the current market companies can succeed if they are based on the right mega trends.
Francesco, got a couple of questions that are coming in. I'm just trying to squeeze them in before we're out of time.
Yep.
We know that there will be a material reduction in private equity deal flow this year, and that goes without saying. Now, why should this be any different at the small end of the market?
No, thanks for the question. I would say that probably we will also see a reduction in deal flow at the smaller end of the market, but I would expect these to be less pronounced than to the general market reduction due to two main factors. First is that less dependency on leverage. As we know, lower end of the market transactions tend to be less levered, and hence if the banks, as in any crisis, and also this one, will reduce the level of lending, the transaction activity will suffer less because it's less dependent on that. So this is a clear factor, and we already see that it's not a problem to raise debt of 30, 40, 50 million for small mid-market deals. It is a problem if you want to raise 200, 300, 400 million, because then you need more banks, complex processes, and in the current market is very cumbersome. But I think the most important factor is that at the smaller end, most transactions are primaries. And hence, typically, the dynamic of the transaction is not about offering the best price to a seller, typically a financial seller who is looking for a buyer, but in the lower end of the market is rather about offering the best project to an entrepreneur or to a family who is looking for a partner to jointly develop the business and then maximize the value in 3, 4, 5 years at exit. So, and as we experienced in the last crisis, although it's a very different crisis, and today still we have witnessed in the last few months that entrepreneurs and family who own businesses are thinking of private equity, this type of private equity, as a solution, and hence deal flow from those sources has increased. So this makes me believe that we are still on a good footage.
Okay, very good. And this is kind of almost like a killer question here. Given that we're only 2 months into the crisis and we don't yet know what the recovery will look like, as you said yourself, I mean, should we really be doing deals now, or should we wait until there is more certainty?
Yeah, another good question. So thank you. Well, let's take it this way. On a high level view, we are for sure in front of the best vintages of the next 10 years. So 2020, 2021, 22 will be the best vintages of the next decade for two reasons. I mean, the capital supply demand dynamics has inverted. As Federico was saying, we are in the buyer's market, so it's very clear. And because, as I said before, if you work on the right projects, if you offer a project and not a price, you can really get into interesting situations where the price becomes less important, and hence it's a very good entry point. And this is possible in this market. Still, I would say one has to assess very carefully market attractiveness, trend in the sector, because it is very challenging, as we said at the beginning. But I believe it can be resolved through, again, something we mentioned, so a profound assessment of the investment teams, as we discussed, management experience to navigate troublesome times, very important, and still do your due diligence. I mean, I would avoid auctions, take time to take the pulse. I mean, we are working on transaction. As I said, we see transaction happening, but these are transactions where it was proprietary process, where we could see the trading on a weekly basis for the last 2 months and have discussion with management ongoing, so that we are really sure that there is little or no impact. So with those, I will go and invest.
Okay, thank you. And we've hit the half-hour mark. I just want to squeeze in one last question to Federico. Given that the larger private equity firms may be unable to do deals now in their usual size brackets due to unavailability of debt, for example, might we see more competition as players start to move down?
So this is a sequel to what happened in 2008, 2009, where the large end of the market tried to come down to the lower end of the market, and for the most part was fairly unsuccessful. And it's not because they're not qualified or they're not good at what they do, but I think the difference is that in the lower end of the middle market, what I would call, there's significant body of knowledge buildup that needs to happen in order to be able to access transactions. That body of knowledge really is the lenders are different, the advisor networks are different, the intermediary networks are different. Engaging with small family companies, small family founders, even small company CEOs, it's almost a different language. The problems that they're trying to solve are very different than in the large end of the market. So my view is they will try, because it makes sense that they do. I think they will have a tough time really penetrating these barriers of entry that are constructed around the lower end of the middle market. And I think what's going to happen is, what you're going to see is these large players actually coming to this market, but ending up in the most obvious place, which is in intermediated transactions, in transactions which anybody can effectively access, that has capital. You're participating in an auction, usually with a well-known advisor, and that is the way that they're going to play in this market, as opposed to the more hard work, roll up your sleeves type work that we see by the best practitioners in the small end of the middle market.
Great, thank you. Now we're just about out of time, so I will now start to sum up. If we just go to the next slide. As a takeaway, we've seen that the small and mid-market has very attractive features during and after a crisis. Firstly, performance through the crisis is expected to be more resilient, and we are certainly seeing this so far in our own existing portfolios, even if the crisis is not yet over. Secondly, emerging from the crisis, we expect to see a range of attractive opportunities coming from this end of the market, which will be quite different in their origins and nature to what will be seen at the larger end of the market, as you heard from Federico. But overall, in these uncertain times, one thing we can say for sure is that the next few months and quarters will test the resolve, discipline, and mettle of any investor, be they small or large. And just onto the last page, I just want to thank everyone for listening and for your questions. I just saw a few more came in at the last minute. So we will come back to you directly on these questions. If you have further questions, please contact us directly as per the details on this screen. And finally, we would very much value your feedback on this webinar. So if you could just spare 2 more minutes, an extremely short questionnaire will appear after this. But for now, and until our next webinar, goodbye, good luck, and stay safe.